Welcome back to the deep dive. If you've been tracking the financial markets at all lately, you'll know things feel a bit tense.
hmm
There's definitely growing investor nervousness around U.S. equity valuations. You see it everywhere.
Yeah, it's palpable.
And the media commentary, well, it's increasingly throwing around that word, bubble, B-U-B-B-L-E.
It does grab headlines, doesn't it?
It certainly does. So our mission today is really to cut through some of that noise.
Right.
We've looked at a whole stack of the latest analyses, and we want to, extract the core truth about where the real risk might lie in this highly valued market.
Get beyond the surface level talk.
Exactly. Think of this as your shortcut to getting properly informed on this really crucial topic, understanding not just what the market's doing, but crucially, why it might matter for your own portfolio.
And that why, fundamentally, it comes down to the valuation metrics themselves. The anxiety is really rooted in this general feeling that, yes, U.S. equities are, well, undeniably richly valued.
Richly valued. Okay.
Yeah. And when we talk about rich valuations, we're mostly looking at forward price-to-earnings multiples, PE ratios.
Right.
Just a quick definition for you.
Yeah, good idea.
So the PE ratio, price to earnings, it just measures a stock's current price relative to its earnings. Pretty simple.
Okay.
But when we say forward PE, we're looking at the current price against what analysts expect these companies to earn next year.
So it's based on future expectations, not current reality.
Precisely. The metric itself has optimism baked right in. So when that number gets high, it means the market is pricing in, well, enormous future success.
Got it. Okay, let's try and unpack this valuation puzzle then, because there's this one common narrative that, frankly, our sources really challenge almost immediately.
Which one is that?
The easy assumption, right? The one you hear everywhere, that these high valuations are entirely because of the top 10 stocks.
Ah, yes, the usual suspects.
The massive AI hyperscalers that have basically pulled the whole index up over the last year or so.
And look, that narrative is tempting because those mega cap stocks, they are definitely trading at some structurally high premiums. No doubt about it.
Okay.
If you look directly at the data for those AI leaders, they are currently trading at a pretty jaw-dropping 30 times forward earnings. 30 times.
Wow. Okay. 30x. That's steep.
It is. That figure absolutely demands extreme optimism. Near flawless execution, really, to justify it.
Makes sense for game-changing tech, maybe?
Perhaps.
Yeah.
But here's the twist we found in the source material, and this is where, you really need to maybe shift your focus a bit.
Okay.
We have to look at the valuation of the rest of the S&P 500 index.
Right. The other 490 or so companies outside the huge tech names.
Exactly. That broad remainder. Well, it's currently trading at 21 times forward earnings, 21x.
Wait, hold on. The rest of the market, the banks, the industrials, the consumer companies, they're at 21 times future earnings.
That's the number, 21x.
That seems surprisingly high. I mean, historically, for just the average company.
Precisely. And that's the key finding here. The source material argues pretty strongly that it's this remainder of the index sitting there at 21x forward earnings that arguably looks most overvalued relative to history.
Okay, I hear the numbers. 30x sounds scarier than 21x just on the face of it. Why is the 21x segment seen as the bigger relative risk? I mean, doesn't 30x for potentially world-changing AI just reflect that huge, maybe structural growth?
It does, or at least that's the argument, right? And that is kind of the difference. When you buy, say, an AI leader at 30x, you're explicitly buying into a narrative of potential market dominance, exponential growth.
Right, a disruption story.
Exactly. And maybe some of those companies structurally deserve a high premium, even if 30x feels rich. But, to put 21x in perspective for the average company in the S&P 500, the banks, the healthcare companies, the retailers,
Right.
the long-term historical median PE for the index, excluding those very top growth names, it's usually much closer to, say, 16x or 17x.
Okay, so 16, 17x is kind of the historical norm for the bulk of the market.
Roughly, yeah. So 21x isn't just a little bit rich. It's quite a stretch, historically speaking, for that kind of breadth across the market. It suggests that the valuation richness isn't just siloed in a few, high-flying tech names anymore. It seems like it's filtered down and sort of inflated the price of the entire benchmark index.
So you're paying a premium for the potential superstars, but also maybe paying a similar premium for the average performers.
That's the risk, yes. Paying a premium for quality is one thing. Paying a premium for mediocrity or just average performance, that's a more dangerous signal, perhaps.
That definitely changes the risk profile, doesn't it? Because if the risk was purely concentrated in those top 10 names, you could theoretically sidestep it more easily.
Right, you could just avoid those specific stocks or sectors.
But if the broader market, the part that should typically be around 16 or 17x, is now demanding 21x, well, we have to ask what's holding those prices up. What's the foundation?
Exactly, which leads us nicely into the stakes here.
Okay, so let's talk stakes. If we accept that valuations are pretty broad-based and historically stretched, particularly in that, let's call it the 21x group, what has to happen next for the market to sort of justify these levels, to prevent a correction?
Yeah, and this brings us right to the inherent fragility of the current market setup, according to the sources.
Fragility, how so?
Well, these high valuations, pretty much across the board, they are fundamentally reliant on one big thing.
Which is?
Aggressive expectations for rebounding earnings growth. That's the bedrock.
Ah, okay, so the market is betting heavily on profits bouncing back strongly.
Very strongly. It's essentially demanding a perfect sequel after what's been a, frankly, tough year for earnings growth in many sectors outside of tech.
Right.
And the problem isn't just that earnings need to grow. They need to grow pretty much flawlessly and robustly enough to make paying 21x or even 30x today look reasonable in hindsight. Yeah, I mean, we're talking about analysts forecasting significant margin expansion, hoping for a cyclical recovery without any major macro hiccups, expecting companies to successfully absorb higher interest costs. Basically, everything needs to go right.
So if the market price today is built on this expectation of essentially perfection, then we're moving into that phase where there's little room for a misstep, as the source material puts it.
That's a phrase they use, yeah?
It really sounds like we're walking a bit of a high wire act, like the smallest economic tremor or maybe a geopolitical shock could trigger a pretty rapid repricing downwards.
That's a good analogy. Think of it like a finely balanced scale. If that expected flawless future execution, the big earnings recovery actually happens.
The scale stays level.
Right. Maybe the PE multiples even compress naturally because the E, the earnings, finally catches up to the P, the price.
Okay.
But if global economic activity slows down unexpectedly, or if, say, sticky wage inflation bites into company margins more than predicted, or if some geopolitical flare-up hits corporate confidence,
then companies might not deliver that aggressive earnings recovery the market's demanding.
exactly, management guidance might disappoint. And that's when the fragile structure potentially collapses, or at least wobbles significantly.
And the premium price disappears.
Because the promised future didn't quite arrive as advertised. And this risk feels particularly acute in that 21x segment, you know? Those companies generally don't have the massive structural growth tailwinds that the AI hyperscalers might have to forgive a slight miss.
That makes sense. An average company missing earnings forecast is usually punished more than a hypergrowth one.
Typically, yes.
So this is really the crucial takeaway for you, the listener. That high price you see on the screen for the broad market, it means you are paying today for some pretty intense optimism about tomorrow.
A lot of good news is already priced in.
Yeah. The risk isn't just that there might be an economic slowdown. The risk is that the current market valuation requires that a significant slowdown doesn't happen.
Yeah.
That's a pretty stringent requirement.
It really is.
Okay, so we've established the risk. It seems broad-based, valuations are historically high, particularly for the average stock, and it all hinges on near-perfect earnings execution.
That sums it up well.
This inevitably leads us to the practical, tactical question. What should concerned investors actually do now? If the whole U.S. beach seems this expensive, what are the options?
Right. And the source material we looked at presents two pretty clear strategic paths for investors who are worried about this valuation risk. Ways to potentially protect capital or seek out better value.
Okay, let's hear them. Option one.
So the first option is really for those investors who want to stay committed to the U.S. market. Perhaps they have good reasons for that, but they recognize that just passively buying the S&P 500 index right now at these levels might be taking on too much valuation risk.
Okay, staying in the U.S. but being more careful.
Exactly. Option one is described as active management for high selectivity.
High selectivity.
The goal here is to be surgical. You use active management not just to pick stocks generally, but to meticulously select only those specific high-quality companies within the S&P 500 that you genuinely believe warrant a premium valuation, maybe even that 21x or potentially higher multiple. Companies that have really defensible profit margins, clear growth drivers independent of the broad economy perhaps, and Crucially, management teams with absolutely impeccable execution track records.
So it sounds like the high valuations almost force a return to really old-fashioned rigorous stock picking.
You could say that.
You're essentially saying if you want to stay invested in the S&P 500 right now, maybe the broad passive index approach, the shotgun approach, is just too exposed to that potentially overvalued 21x segment.
That's the argument.
So investors are kind of forced into more of a rifle approach instead, aiming very carefully.
Precisely. You have to try and discard the broad index assumption and become incredibly selective about what you own within it. Find the exceptions that justify the price.
Okay, that makes sense. High selectivity within the U.S.,
Yeah.
but that sounds, well, hard. Requires a lot of skill and research.
It does. Active management is challenging, which leads us to option 2. If that level of intense selectivity sounds too difficult, or if you're just fundamentally uncomfortable with U.S. valuations overall, option 2 addresses the value problem by literally changing geography.
Okay, option 2 takes us outside the U.S. then.
Yeah.
Where else can investors look for shelter or better value?
This is the regional rotation strategy. The logic is pretty straightforward. If you're worried about paying a high premium in the U.S. market,
Which we've established is the case.
then you rotate at least some capital into other established regions where quality companies might be available but cheaper.
Cheaper how?
Well, the crucial detail here is that these other regions, other developed markets or even emerging markets, are currently trading at what the sources call steep discounts to the U.S.
Steep discounts. Okay.
So the idea is you're not necessarily sacrificing company quality or governance standards dramatically, depending on the region, but you're buying exposure at a significantly lower PE multiple.
Why are they cheaper?
Often because of maybe more regional pessimism, perhaps slower overall projected economic growth for that area, or specific sector weights that are less favored right now. But the underlying companies themselves might still be structurally sound global businesses.
So it's about finding value where the market sentiment is maybe less euphoric than in the U.S.
Exactly. This is where investors who prioritize finding, a margin of safety and valuation are often forced to look, especially when the home market seems priced for perfection. It's about finding value over chasing that dominant U.S. growth narrative, potentially.
Right. That gives investors a really clear fork in the road, doesn't it?
It does seem that way.
Either you commit to the really high selectivity, the discipline, the hard work required for option 1, staying hyper-focused on picking only the very best within the expensive S&P 500.
Right. The surgical approach.
Or you pursue option 2, you look abroad, seeking potentially deeper value where the starting valuations are just significantly more attractive, which in theory creates more of a buffer if earnings do disappoint globally.
Yeah, it's fundamentally a choice that's driven entirely by how much risk you're comfortable taking on the valuation front right now. Are you willing to pay that 21x for the average U.S. business, banking on perfect future execution? Or are you actively looking for a lower starting multiple, something that already bakes in a bit more room for error?
A crucial question for everyone.
Indeed. So just to quickly summarize the core dichotomy for you, the S&P 500's high valuation, it's often talked about as only being about the AI giants trading way up there at 30x.
Right, the common narrative.
But crucially, the rest of the index, the bulk of the market, is also trading at 21x, which is a historically stretched valuation for the average company.
Okay.
And this entire structure, both the 30x and the 21x parts, it really relies heavily on pretty flawless, strongly rebounding earnings growth to justify these current prices.
And that reliance on near perfection, that's the high wire act we're all watching right now.
Well said.
Okay, so to leave you with a final, maybe provocative thought to mull over, let's put some real numbers to that steep discounts idea we mentioned for option 2.
Good idea. Context is key.
Right. So the overall S&P 500 index, remember, that includes the expensive 30x tech and the 21x everything else it currently trades at a forward PE of roughly 22.7x, give or take.
Okay, 22.7x for the whole U.S. market average.
Now consider what option 2, regional rotation, offers in comparison, just as examples from recent data. MSCI Europe, that index is trading around 14.9x forward earnings.
Wow, quite a difference. 22.7 versus 14.9.
Big difference. And MSCI Emerging Markets, that index is trading even lower, somewhere around 13.9x.
Okay, so nearly a 9-point PE discount compared to the U.S. and emerging markets.
Exactly. So when you look at those stark numerical differences, a 22.7x index here versus a 14.9x or a 13.9x index over there, it certainly makes you ask the question, doesn't it? What is the true cost of paying such a significant premium to stay exclusively focused on the U.S. market right now, when potentially similar quality, perhaps for considerably less, seems to be available elsewhere?
A very important question for global investors.
Definitely something to mull over as you assess your own portfolio's valuation risk exposure. Thanks for diving deep with us today.